Welcome to our today's feature presentation, what a trade repair strategy can do for you. We'll invite you into the thinking that at any entry into a trade, you can also assume a plan B. If the trade goes wrong, instead of walking away with a stop loss, that you can turn the trade that is potentially a loser into a winner or minimize the losses. My name is Thomas Barman. I'm your presenter today, and I want to make you aware of the risk in trading. With this done, let us dive into it. When we trade, we predict the future outcome of a price move, and even so we do that with the Never Lost Trading Systems and TradeColors.com with high probability. We have trades that go wrong, so they move immediately or in the duration of the trade in an opposite direction. So instead of taking a stop loss, we can adjust the trade, and this is originally where our name comes from. Never stop loss trading, but it was a little bit lengthy, and so therefore we bunched it together at Never Lost Trading. And I give you today an example where that recently happened on an exploratory trade. However, money is money when it goes into the market. We want to defend it and get as much back of it or of as much return as possible. In a quick summary, so instead of taking a stop, what do we want to do? We want to do a trade repair, and I'll invite you in how that is done. In our research work, we're currently testing an opening pressure indication. So we want to find stocks that have options and a good option chain, and then trade their options with the direction that market pressure gives us. So on June 28, just recently, Procter & Gamble came up, and at 9:33 a.m. we bought call options. Call option positions for that. So what did we assume? Thing goes long, and we had also a target price on the chart. I show that to you in a moment, and we paid 38 cents per share controlled for the contracts we bought. And so then we'll see on the chart in a second how the entry was and what really happened. What you see here is the chart for Procter & Gamble 2 minutes after the entry. So we had the market pressure. We felt that is a long setup. There was the target of the trade, but also we had an adjustment level down here, which I didn't paint on this one, but you see it in the moment, because that was the reality that triggered. We didn't do that bullish cup going to the upside. No, that trade turned right away on us and put us under pressure. But was the pressure high? No, absolutely not, because at the beginning of the trade we had a plan B, and I'll show you how. So you saw what started beautifully at the beginning at 9:33 and looked like we are doing this, turned out to be one of the nightmares, because at 10:40 we'll have to do something, and at 10:43 we took the action because our stop point was triggered. We all calculate those, and so it was triggered, but instead of taking a stop loss, which would have led to a detrimental result, because for that trade on the short-term option that we bought, we would have only gotten like 8 cents back, so 30 cents of the 38 cents would have been wasted in a very short period of time. So in such situation, we needed a plan B, a repair strategy. Something to do that turned a very unfavorable situation into a favorable situation for us with a controlled risk. So what we did is we opened a credit spread, 50 cents wide, and we received a premium of 48 cents. So now let's calculate that all together, what it means for you as a trader. So let us jointly add up the numbers for this trade on a plain sheet, and we want to go a little bit in detail with you, because option trading is a penny business, a nickel and dime business. You have to be on the spot to come out clear with that. It's beautiful business because of the opportunity for using leverage and for limiting your maximum risk. But when things go wrong, you will see what can be all done to move them into the right direction. So at the beginning of the trade, we invested 38 cents per share. So the Procter & Gamble comes with 100 shares controlled per contract, so that would be $38 per contract. And you saw that surely went wrong, and we had to do something, because had we exited at the stop, a loss of 30 cents out of 38 would have been made, so that's an 80% loss. That's a high loss for this, but that's happening often to trades in the arena of options when we use short-term options, which we did here. So for the repair we did, a 50-cent wide spread, we received 48 cents of premium. That's ours to keep as long as the conditions of the trade are met. On the other hand, that gives us a potential of a return on investment here of 26%, if we are right with the credit spread of how we laid it out, will even turn that losing trade, which would have lost 80% at the get-go, into a 26% return, and so we are positive in the money. And how much risk did we take? We took just 2-cent risk here, 50-cent spread with 48-cent premium. The difference is 2 cents or 5% higher risk. That's very standable for that trade. So all in wonderful conditions for a trader to repair the trade and to come out clean, even though the base assumption didn't work out. The bars here, or the candles on the left, identify what we had expected from this trade and how it turned out. So here we had entered, assuming that the price is going to go up there, yeah, to our target, which it didn't. Yeah. Then we had adjusted our trade on the way down, creating a credit spread. So with that we had bet or traded now to the downside with that credit spread. And a day later, what Procter & Gamble made this for us. Said, okay, it moved to the downside. So the question will be now, how did it calculate up in numbers, and were we able to turn a losing trade into a winner? Yeah. So we had originally invested 38 cents. Had we closed the credit spread, or if you closed it, you would have done that for a premium of 3 cents. Yeah? So all in all, you would get 45 cents out of a 38 cents investment, and so you have a positive return. You turned a losing trade where you assumed to lose 80% of the premium paid into a winning trade, and you'll be able to close it and get it out of the way. Or the other possibility, you wait and ride it out and you make the additional 3 cents of premium for a 26% return on capital invested. So that means you can turn losers into winners if you have the right instruments on hand. If you like to learn trading this way, the Never Lost Trading way, give us a call or write us an email at contact@neverlosttrading.com for more information. We have several systems that you can operate with. Our basic system is tradecolors.com, and our most advanced system is called Never Lost Trading Topline. We'll teach all of them one-on-one, and we work one-on-one individually with you for the best focus at your best available days and times. So we are looking forward to hearing back from you, and hope we provided a good value in our today's presentation. Thank you very much for your attention.